Hey there and welcome. Today we're going to tackle one of the most fundamental concepts in economics and finance, liquidity. Now I know it's a word you've probably heard thrown around a lot, and by the end of this, you'll know exactly what it means and, more importantly, why it matters so much.
All right, let's get right into it. Here's our game plan for today. We'll kick things off with a simple definition, then we'll get into why it's so important. After that, we'll see how it works in the bigger picture of the economy, use a simple example to make it all click, and then look at its impact on financial stability before we wrap it all up.
So, first things first. Let's get a really clear, solid definition on the table. What are we actually talking about when we use the word liquidity?
Okay, so at its heart, liquidity is all about two things: how easily and how quickly you can turn something you own, an asset, into cold hard cash, and this is the really crucial part, without having to sell it for less than it's actually worth. Right, so think of it as a spectrum. On one end, you have highly liquid assets. That means selling is fast and you get a fair price. On the other end, you have things that are not very liquid, or illiquid. That means selling it might take a long time, or you'd have to accept a much lower price to get rid of it quickly.
So that naturally leads to the next big question. Why does this matter? I mean, why is liquidity considered a cornerstone of financial health for pretty much everyone, from you and me all the way up to the biggest companies in the world?
Well, this is where the rubber really meets the road. Liquidity isn't just some abstract theory. It's what allows a business to actually pay its bills on time. Things like salaries and rent. It gives them the flexibility to jump on a good opportunity, or just as importantly, survive a sudden crisis. It's a huge signal of stability, and that helps build confidence with investors and banks. Now, here's a crucial point. Liquidity isn't just one single thing. It really operates in two main arenas: out there in the broad financial markets, and also inside a single company's finances, what you'd see on its balance sheet.
The easiest way to think about it is like this. Market liquidity is about the health of the entire system, like the stock market. How easy is it for everyone to buy and sell stuff? Accounting liquidity, on the other hand, is zoomed in on just one specific player in that system. It's asking, can this one company pay its bills?
And to really understand this, it helps to see how different kinds of assets stack up on that spectrum of liquidity we just talked about. This lays it out perfectly. At the very top, you've got cash. It's already cash, so it is, by definition, perfectly liquid. Right below that, you have things like government bonds and stocks, which you can usually sell in just a day or two. But as you go down the list, things get tricky. Real estate, art, a private business, these things can take months, sometimes even years, to turn into cash for their full value.
All right, that's enough theory for now. Let's make this concept really solid with a simple, everyday example to see how a lack of liquidity can create a real headache.
Okay, so picture this. Your refrigerator just completely died. It's done. You need a new one, and you need it today. The one you want costs $1,000. The question is, where are you going to get that cash?
Now, let's say you don't have $1,000 sitting in the bank. But what you do have is a rare book collection that was just appraised for exactly $1,000. So technically, you have the value you need. But there's a problem. The appliance store doesn't want your books. Your asset is illiquid.
And this right here, this is the cost of illiquidity. To get that fridge today, you can't afford to wait for that one perfect collector who will pay the full $1,000. You probably have to find a used bookstore or an online buyer who can pay you now, but they might only offer you, say, $800. You're forced to trade value for speed. So if you take that exact same principle and you just scale it way, way up, that's what businesses and even entire economies are dealing with all the time. For them, liquidity is this critical balancing act, and getting it wrong can have huge consequences.
What's really interesting here is that it's not just about having enough liquidity. A company can actually get into trouble by having too much cash just sitting around doing nothing.
And this table really shows you those trade-offs. If liquidity is too low, you're looking at a serious risk of not being able to pay your bills. That's called insolvency. But on the other side of the coin, if you have too much cash on hand, well, that's cash that's not invested, it's not growing, it's not working for you. That's a huge opportunity cost. So the real goal is to find that sweet spot right in the middle. So, how do companies and investors actually measure this? How do they know where they stand? Well, they use a whole toolkit of financial ratios, and each one gives them a slightly different view of the company's financial health. Let's just quickly touch on three of the most common ones.
First up is something called the current ratio. You can think of this as the broadest, most general checkup. It just compares everything the company expects to turn into cash within a year against all the bills it has to pay in that same year.
Next is the quick ratio, which is sometimes called the acid test. Now, this is a much stricter measurement because it takes inventory, the company's products, out of the equation. It basically asks, if we couldn't sell another thing, could we still pay our bills?
And finally, we have the cash ratio. This is the most conservative of all. It only looks at the actual cash a company has on hand and compares that to its immediate bills. You could call this the worst-case scenario test.
Okay, we have covered a lot of ground here, from the basic definition all the way to the tools analysts use to measure it. So let's just take a moment and boil it all down to the most important points to remember.
So, to sum it all up, liquidity is simply about turning something into cash quickly without taking a big loss. It's absolutely vital for financial stability, for paying bills, for surviving a crisis. And remember, all assets live somewhere on that spectrum, from cash on one end to something like a private company on the other. And the real key is finding the right balance.
And that leaves us with one final thought to chew on. Understanding liquidity really changes how you look at value. It's not just about what something is worth on paper, it's also about how accessible that value is when you actually need it most. Thanks for watching.